How do you choose stocks for the wheel strategy? I'm Jay for MedPicks. Most traders start in the wrong place. They open the options chain, look at the premium, and start hunting for the biggest payout. That's a huge mistake when talking about the options wheel. When you trade the wheel, you're not only selling premium, you're choosing a stock you may have to own. Very quickly, the wheel starts with selling the cash secured put. You collect premium upfront, but you're also agreeing to buy 100 shares if assignment happens. Once shares are assigned, you start writing covered calls on the shares until they're called away. And then you do the whole thing over. So before premium even enters the conversation, ask yourself one simple question. Would I be comfortable owning this stock? If the answer is no, then I would really recommend that you keep looking for a better stock to trade. Remember, there's no rush to get started, and this will really matter if assignment happens. Next, focus on established companies you'd actually be happy owning. Look for businesses with a long operating history, consistent earnings, and manageable debt. You don't need to know every detail, but you should understand how the company makes money and why you'd be comfortable holding the shares if you're assigned. You should, at a minimum, review the company website, read some of the recent press releases, especially earnings announcements, watch or listen to the latest earnings call, and maybe even read the company 10K and recent 10Q filings. With that, you should have a basic understanding of the business. Next, check the chart. You're looking for stocks that have been reasonably stable, moving sideways, or trending higher. If a stock has been making lower lows for weeks or months, there's usually no reason to rush into selling puts on it. So now let's bring up the options chain because for this example, we're going to look at the AT&T $23 put expiring August 21, 2026 with a midpoint premium of $1.35. One contract would bring in $135 before commissions and fees. Before we ask if this trade makes sense, we have to check liquidity. On the screen, this contract has good volume, recently trading 165 contracts and 980 contracts of open interest, which is a good sign. Good liquidity helps you enter and exit positions without giving up profits from wide bid-ask spreads and greedy market makers. Now think about your account size. In our AT&T example, selling one $23 cash secured put means you need enough cash to buy 100 shares at $23. So you'd want $2,300 set aside in your account. If tying up $2,300 in one position feels like too much for your account, look for a lower price stock or simply wait until your account grows. Remember, higher premiums usually come with higher risk. If one stock pays significantly more than another, there's often a reason. Next, it's good to check the calendar. Earnings, dividend dates, lawsuits, major announcements, anything capable of moving the stock hard needs to be on your radar. Bad news can push a stock price through your strike fast. When price moves hard, the wheel can start showing a loss. And this is where we get to the main point. When you sell puts for the wheel, you should sell them at prices where you'd actually be willing to buy the stock. Using this AT&T example, the strike price is $23 and the premium is $135. So the effective buy price is $21.65. If you sold one contract, the max profit would be $135 if the option expires worthless. The cash obligation would be $2,300, the break-even would be $21.65, and the theoretical max risk, if the stock went all the way to zero, would be $2,000 and $165. So now we're not predicting that AT&T goes to zero, but the point is to understand the math. If the stock is trading around $23.50, the $23 strike is slightly below current price. A break-even near $21.65 gives you some cushion for the current stock price, but you're still accepting ownership risk. Then also think about the next step before you enter. The wheel is a full cycle, so at the signed, you own shares and the next step is selling a covered call. Before assignment happens, you should already have a rough plan. Where might you sell calls? Would you be okay letting the shares go? How much income would make sense? I wouldn't wait until assignment to figure out the second half of the strategy. Another thing is to diversify your watch list. Don't run the wheel on 5 stocks in the same sector. 5 telecom names is one giant sector trade. Build a watch list across different areas of the market, including different industries, different kinds of stocks, and maybe even ETFs, as long as they fit your account and process. So in all, how do you choose stocks to the wheel strategy? Well, use this checklist. Pick stocks you understand and wouldn't mind owning. Make sure the company is solid and the chart isn't falling apart. Check liquidity before you chase premium, and know the assignment math before selling the put. Choose quality stocks you're willing to own and avoid huge premiums. It's often a red flag. If you want more ways to make money with options, please click the link below and download the free report. And don't forget to like and subscribe.